next time on Serenade. So let's see what's going on. WBA coming up, yeah. On the rise, just like we pictured. Look, this is what I'm talking about with the dollar. This is insane for the dollar in a single day. It went all the way back to 101.50, but it's based on, people extrapolate data off of single data points, which is not the way data works. And so if you get one improving point, everybody starts, like literally on CNBC, I stopped watching it. It was so stupid. They had all these analysts coming on, like, well, the Fed is done. In that case, this is a complete reversal, and they've probably gone too far, and now they're going to have to start lowering rates because they've gone way too far the other way, and inflation is now zero, and blah, blah, blah. And it's like, shut up. It is so insane. People are just crazy. So where is that? Let me see if I can find it. Briefing.com. Yeah. Yes, he looked in the right place. Haven't looked at that for a month. There we go. So today, CPI. And we're waiting on the beige book. We're going to check that out in a little while. So here's the updated CPI. Really not a big deal. The overall core CPI is still 5%, basically 5% for the year. That's year over year. Today, it was 0.2%. So for this month, it was 0.2%. It's still that lowered the year, but not by much, because if the average for the year is 5%, that means every month it should be 0.4%, right? So 0.2% in 1 month is only going to lower it by a certain amount. Now, if it continues, it'll help, but imagine you have 6 months at 0.4%, that's 2.4%, right? Then you have 6 months at 2%, that's 1.2% for 6 months. So 2.4 plus 1.2 is 3.6. So at best, if we continue at 0.2%, we are still going to have this inflation, 3.6, for the full year. This is the total CPI, not the core. This is including food and energy. But you see, so in other words, if everything goes fantastic and the core CPI stays at 0.2, it'll be down to 3.6 this year, which is still significantly higher. 3.6 is actually up here. It's still significantly higher than the 2% Fed target. So the Fed has not done their job. They are not done fighting inflation. They have not gone too. People don't understand how to read data. People don't understand how to read graphs. And I understand the average person doesn't know this. When I go to the grocery store, I don't attack the guy for not knowing how the core CPI is affecting his groceries. But when I hear somebody on TV spouting off bullshit that they don't understand, I get pissed off, because I'm one of those people, and it denigrates my existence. I mean, I'm just, you on TV, I'm just like another idiot spouting off crap when they look at it. Because you don't put stock. It used to be, once upon a time, before Fox existed, that if you saw a guy on TV being interviewed, you would assume that he is probably an expert and knows what he's talking about. Because the news show would be embarrassed if they brought somebody on who wasn't an expert and didn't know what they were talking about. And that was back in the days when we had proper political discourse and proper economic discourse, and you would have two experts with differing opinions, but they would generally be coming out of the same branch. In other words, you'd have Keynesian economics, and you'd have what's the other guy's name? Keynes and the other guy, Hayek. So you'd have Hayek, the Chicago School of Economics. You'd have Keynesian economics, which is a more liberal, government-involved sort of economics, and Hayek's a more laissez-faire school, like the Chicago School of Economics. But it's a difference. Nobody's questioning the basic theory of economics. They both went to the same school. They both know how economics works. They don't disagree on supply and demand curves. They don't disagree on that. What they do disagree on is how to then influence them. Okay, but now you have people arguing the basics, like, does gravity exist? Yes or no, pro, con. And they'll sit somebody down in the anti-gravity position and start arguing that the whole concept of gravity is made up by the government. It's to trick people into staying on the ground when they could be flying. This is all bullshit. And it's sad. It's really sad. The whole world's turning into just a bunch of nonsense. Like, people just make up their own shit. And they go on TV. That's what's pissing me off, right? Because I worked hard to get to go on TV back in the day. And people respected my opinion, and I was there, and going on TV automatically meant you were recognized for something. Now going on TV means you're filling a slot on one of 1,000 channels, which is why I stopped doing it. I mean, I got really, you know what got me? The box, the CNBC with the 8 people in a box, all talking at the same time. And I was one of those people once, and I was so angry about it. I was just like, because I went back after going to the city, sitting in the studio for like an hour and a half, waiting for my turn. Then I find out that I'm on with 8 other people being interviewed by one person, and we're all going to be talking at no more, your answer cannot be more than 30 seconds on whatever it was they were talking about at the time. I don't remember the topic anymore. But it's garbage. It's garbage in, garbage out, right? And of the 8 people, there were only 2 whose opinions I respected in the least. So no, thank you. So that was one of the things that led to me like deciding I didn't need to be in New York anymore. It wasn't even worth it. It was just a joke. Anyhow, speaking of data, so make sure you have the right data set. Another thing people do, like they'll look at the chart, they'll look at this, and they'll assume that this chart has been updated, but you got to make sure it has been updated. It says June, so that's good. Total CPI for June was 0.2%. So you make sure you're reading the right data set. So what happened? Food and beverage, weak. Well, weak is good, but for food and beverage, low inflation. Housing, compared to what though? It was 3, 0, 0.1, 0.2, 0.1. Seems like it's just erratic, right? It's not there's not a particular improvement here. It's just erratic. The same thing with 0.2. It was 04, 01, 04, 01. What's the average of that? It's basically 02. It's 0.025, in fact, is the average. Housing, 53223. Well, it's going back up, right? Equivalent rent, and again, 75554. That's an improving trend. You can see that. Apparel went from 8, maybe that was just a spike because we don't have the rest of the data, to 3. I mean, this is how you read a report. You pick it apart and make sure you understand what's happening. Transportation, super erratic. 02, -5, 1.2, -02, 02. I can't believe you can possibly draw any kind of conclusion from that. Vehicles are -6%, down, up 2%, up 1.2%, up 1.2%, down 0.1%. So we're no better off than we were in February when we went down to 0.06. We had a couple of whopper months, and now we have one down month. Okay. So far, there's nothing I'm excited about. Motor fuel. Now, this is interesting too. Up 1, -4, up 3, -5, all over the place, -1. This is, if anything, a lower minus than previous minuses. I'm sorry, it's not even -1. What am I talking about? +1. It's +1. So maybe improving, maybe not. Again, who can tell? Cannot make a conclusion from this. Medical care, -5, -3, 0, +1, 0. So it hasn't been going anywhere all year. Education and communication, I guess, I suppose. So 1, 2, 0, -2, -2. Okay, that's improving, which I can't. Frankly, we're hitting the $100,000 a year mark on colleges now. On the upper end schools are way over, like 80, 90. Some are getting, they're starting to like cap themselves at 99 because it just seems like 100 is outrageous for a year of college. So I think that's part of it. I think they just hit the limit of what people are willing to accept before there's a revolution against the whole concept. And it is pointless. You guys have been to college, right? I mean, you pay, I don't know how it works now, frankly. Even though I have my kids in school, I just pay a huge amount of money. I don't know why. It used to be we were kind of paying for the credits, but it wasn't really cheaper if you took less credits. So I guess it was like you could take up to credits. I don't know what the concept was, but they used to like say it was this much per credit, but that didn't make any sense because you pay the same bill either way. But point being that most of college, not most of college, first 2 years of college, mostly sat in large classes. Now, I'm sure it's not true for everybody. I was a business major, but mostly sat, I was a business major, you know, in the program that had a lot of people enrolled too. So, you know, mostly large classes, 50, 100, sometimes 300 something people in a lecture hall. So you're getting no individual attention. I'm getting nothing more out of that than if I log into a college course now online and watch it. I'm watching it. Frankly, a way better teacher online. I'm watching one of the best teachers in the country, mostly. And well, I look at all the Ivy League courses. I like those, but you know, you get some really, really good teachers. And you sit there and you pay attention. You can pause it and go to the bathroom. You don't have to sit there and wait for the bell to ring, getting distracted. I like taking college courses online. They're free. I mean, right now they're free. They haven't figured out how to really monetize it. But to me, and I wanted to do this years ago as a business plan, but now it's an obvious reality, is why don't you just, you know, hire moderators and students will pay for the moderators, for the teacher's assistants, essentially, who are going to then take your papers, grade your papers, so on and so forth. The professor's only there to lecture. He doesn't oversee the papers. He doesn't, you know, I mean, you know, maybe some outstanding students, maybe some great questions. You can figure that out one-on-one time. But what are you missing? If you can instead of charging $100,000 a semester for somebody, you can charge $20,000 a semester and they can get the same college education. And maybe you do that for 2 years, and then in years 3 and 4, you can pay up and go to the college, but still you're saving a tremendous amount of money. Because what we're doing now is madness. And I think the real shocker of this Biden student loan thing is that they're talking about forgiving $10,000 of student debt when student debts are $100,000, $200,000, $300,000 coming out of school. Well, I said, who the hell cares for $10,000? I don't know where these people are going that they're only $10,000 in debt. I mean, I guess they had some savings and they supplemented or whatever, but you know, these schools are insane. I cannot believe the average person has that much money put away. So anyway, education all over the place. Core, okay, that's the thing. Energy, obviously excluded from the core, is -6, -3, +6, -6, +6. That's not down. And services, 5, 3, 2, 3, 3. It's not down either. So by a simple weighting trick and not a trend, because look, every single one of these numbers is positive except for education and vehicles, and only very slightly down each one. So this tremendous change to the core CPI is really only due to just a couple of numbers that were large last week or not large this week. And of course, motor fuel excluded from the core, so it didn't count, even though it was a big drop last month, so we didn't pick it up. But so it's great to look at the headline, which is what every lazy-ass analyst does. But if you don't know what's underneath what made that number, then it's pointless. So I'm telling you, this is not a major improvement in CPI. So it is obviously an improvement, but it's certainly nothing I would sit there and celebrate and change my investing strategies based on. Yet, boom, the market goes crazy. Not only that, though, but the dollar went insane, as if inflation is completely over and the Fed is reversing their policies. That's no way that is happening. So this being wrong, a 1% drop means that unless you have a significantly more than 1% pop, and this is 0.5%, 1%, 1%, 1%. So unless you have significantly more than a 1% pop, these two cancel out. And I don't want to be repetitive, but I mean, you got to get this concept in your head that if a dollar look at this. SunPower up 9.5%, baby. Stock of the decade. So this is the time at which I finish banging the table. Like I've been banging the table on SunPower. We have it in, I don't even know which portfolio. I think we have it in every portfolio pretty much. In the income portfolio, for example, here you go, right? I don't remember if I don't know if that reflects the last changes we made, but I'll see. But anyway, I am blank on this word. Anyway, our intention was, I seriously had a word in my head. I seriously had a word in my head and it's completely eluding me. It's so annoying. It wasn't consistently. I'm sorry, but it bothers the shit out of me. It's like, it's nothing worse than feeling like a hole in your brain. Like it's just, it's when you never had it before, like I'm just turning 60. It's not that old, but I'm for the first time in my life, I'm starting to like miss words, and I've never done that before. And it bothers the shit out of me when it happens. I guess eventually I'll get used to it, and it won't bother me when I miss words. But I can't believe I can't think of what I was going to say. Anyway, my intention for trading SunPower was we were aggressive. Well, yeah. We were aggressive. We did 50-30 on the long side. So we got 20 more longs than shorts, but it was an income play also. We sold some September 12 calls. And it looks like our target's going to be right. Everybody's worried we weren't going to hit the right target, but our target might be correct. The net of the trade, and it's only from May. The net of the trade was 19 minus 5 is 14, minus another 6 basically is 8. And minus 2 is 6. So basically it's a $6,000 spread or $6,000 cost that we laid out. It is 50 times 8 is 40,000. It's a $40,000 spread that we spent $6,000 net dollars for, and we're going to sell more of these short calls. When as it rolls over. So we'll eventually roll our cost basis down to 0 by consistently selling short calls. And we think we're going to be, we took a very conservative target on SunPower at 18, or I thought it was conservative. It's been down the whole time, though. It hasn't improved at all. We're finally in the green. We weren't in the green for a long time. But now, so we're up, these two cancel out. So we're up $1,200. It's not much considering the upside on this thing is $30-something thousand, about $34,000 upside potential. So we've used 12 of it so far, so it's still a spectacular play. So instead of being net 6,000, it's now, let's say, net 8,000, not even, on a $40,000 spread that we have extreme confidence in, and we're picking up $2,000 every 3 months or so selling short calls. Great trade, great company, super undervalued. And when you see a pop like this, then you got to realize that people are catching on. So certainly not because of what I said, because I've been saying for like the last year. I mean, look at this stupid thing. Not well last year. I mean, I've been saying since it hit $10, I've been telling people like, what on earth is happening here? It's just the wrong price for this stock. We're looking for 18 to come back. If we pick up a longer term chart, I mean, it's been very, very sad. Here's the longest term chart. So basically, we've been down here and bouncing around since May. And overall, it's been very, very disappointing, but we didn't care before. So now we're like super bullish. Anyway, so and just look again, this is fundamental investing, right? It's not about the chart. Oh, in fact, where's top trades? Top trades. That's me. This is watch list. We don't want to get rid of that. All right, I will open up yet another PhilStockWorld window. PhilStockWorld. Ew, I don't like that. What is that? Why does it look like that? Home. Sign in. Maybe because I'm not signed in. Is that how it looks when you're not signed in? I find that hard to believe. There, that's how it should look. That was weird. Okay. Did I not set a picture for today? I feel bad about that. Okay, I have to do that. Here. Let's do that now. No worries. I knew I got done with my article too fast. That takes like 2 seconds. I just forgot. The holes. Oh, that's interesting. You know how many years of webinars we got? I think it'd be very fascinating to study the decline of my cognitive abilities. Okay, we did that. Okay, so it's just really set a featured image. That's all we have to do. And here are the potential featured images. I could add a new one, but I'm obviously not going to take the time right now. We did a nice S&P. How many images do we use per day? Wow, look how many images got put up since I did the post. That's all over the site on different articles and news and things like that. Oh, that's interesting looking. I wonder what that is. It's probably the EIA. North Korean missile tests. God, forget about them, right? Anyway, all right, S&P. That's the NASDAQ, I know that. So we'll use the S&P as our feature chart. Set the image. Update. Ooh, a comment is being held for moderation. We should fix that too, right? So housekeeping stuff at PhilStockWorld. Let's see what happens. So anyway, yeah, some neurologists should take all these webinars, because we've been doing them for what, 10 years or something like that, and keep track of my cognitive decline based on everything I say during the webinar and how I say it and what words I miss and what I do and don't do over time. It'd be fascinating. It'd be depressing for me, but it'd be fascinating for other people. Because I don't think there are that many people who have, all this content, just kind of, especially high thinking content, let's call it, or intellectual content, because this is all very mind intensive when I'm doing this stuff. Comment pending. CE says, oh, he made a good observation. Some power flying at pre-market. Don't miss the boat. Previous 2 times. Oh, see, it sounds like an advertisement. That's why it got spammed. That's what it is. See, you can tell because it's an AI and it looks at that and it says, oh, that sounds like an advertisement, so I'm going to hold it. Where is spam? Well, there's foreign spam now. You have no idea. Like every day, it's like hundreds and hundreds of spams come to the site, and they get looked at and thrown away, and they pretty much all get thrown away in the end. Look at that, 800,000 comments, 134,000 of which are mine. That's crazy. All right, how do I get back to my site? Here we go, visit the site. Conceptually, that's what I was going to say. I knew it was a C word. See, in the back of my brain, it's still like there's still wheels turning in the back of my brain trying to spit out the word I forgot about 10 minutes ago. All right, so now see what that does? It's because if I forget to put a picture, a featured picture, then it doesn't come up there. And here's last week's webinar. I don't remember if that was good or not. Oh, speaking of last week's webinar, though, where is that? There it is. All right, let's talk about that for a minute. So we added these 4. Well, we added on Wednesday. We added these 4 things, and now I need an extra window. Well, where's that window we just made? Well, no, that's not the window I need actually. I'm going to pull out the chart. There we go. And let's see how we did. The sun power is up a nice 10%. We're good about that. The webinar last week, here you go. So we selected out of a group, we selected Barclays, BCS. Oh, wow. Ooh, very good. So here's last week. Barclays, as I said, is stupidly low. They are 769, the 20257, blah, 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 whatever. Okay. So Barclays, Ford, 1537, still 1537. It went down and then it went back up. So we have that one. And GoPro's had a basically up time since then. I didn't say the price, but it was obviously down around 4. Now it's 427. And that's 10%. Doesn't seem like much, but it's 10%. Oh, Jesus. And Trox exploded. Yeah, it was no recession play. Wow. Wow, I'm glad we took that. Okay. Anyway, so now we have to start thinking about what didn't we take? All right, and there were several other suggestions that we looked at. So we looked at, I forget which ones they took. Barclays, Ford, here's Barclays. So BTG we skipped and they didn't go anywhere. What I say about them, BTG is a gold producer and they make 350 million. They have money, they're good, we like them, but we already have GOLD. So I didn't want to double expose. I mean, that's not the best. And look how they're a better gold company, Barrick Gold. So we already have this one. And I didn't choose to add BTG because it's redundant to, these are the best in the business and these guys are not, but they're an interesting play. I just didn't think they were the one to go with. GoPro we did go with. GSL, Global Shipping, a containerly shipping company. They made money, expected early, nice. And this is not updated. Oh, maybe I can just see, maybe I can just do an update on here. Let's see if this will refresh. Sometimes the charts refresh, sometimes they get stuck. No, I don't think it's refreshing. Interesting. All right, so GSL, yeah, way different. No, wait. Oh, I'm sorry. No, this is weekly. It didn't look like it refreshed, but it did. This is weekly, this is daily. That's why it looks so different. All right, so GSL obviously straight up since last week. Still, obviously, we still think they're cheap because they had a very small market cap, and I'm starting to maybe get more confident there. My worry on shipping companies is a lot of shipping is being tied up. A lot of shipping is being tied up with the Russian oil. It's being ferried all over the world. There's a whole shell game being played with the Russian oil where it's sanctioned, but they're still pumping it and they're still selling it, and therefore there are container ships all over the world transferring from container to container. It's a big scam. Like, you're not allowed to buy Russian oil, so a tanker leaves Russia and goes to the middle of the ocean and transfers its oil to another tanker that was listed as leaving full from a different port. So in other words, the tanker leaves from a legal port where oil can be sold, right? It claims to be full, but it's not. It goes to the middle of the ocean where it meets up with a Russian tanker, which fills the other tanker. Now, this, of course, has the potential to become an environmental catastrophe if there's a huge spill, but you cause it by criminalizing the behavior. It's the same thing with like drugs, right? By criminalizing the behavior, you make it worse. You're not helping by doing that. It doesn't stop the trade, it only makes it more dangerous. But anyway, but these guys are a ship leasing company. They're not a ship owning company. So generally, I like them. They're just financing ships, basically. And there's definitely a strong demand for ships. So I like them. And again, the only other issue I have with the cruise ships is they're an environmental nightmare. Cruise ships, especially, but any shipping is actually environmentally horrifying. And that's going to get cracked down on. I'm not sure how that's going to affect the overall thing, but it may devalue the ships that these guys have under contract, and that's a little bit of a concern. Nokia we didn't do, and for the week they're up. Not much. I mean, if you go back, that's basically the day we were looking at them. Still a little high. They were 418, now they're 428, so not a big deal. But I like Nokia. We'll have to consider that strongly. Petrobras lost ground apparently. And I said, would be great, but the government forces them to give oil away to Brazilians. Even now they are trying to sell assets and the government is interfering in a riskier portfolio. I don't mind it, but not here. So that was good advice at the time. Trox exploded. Wow. Well, we saw that one. That's one of the ones we did buy. So, now we go back and we re-look at the things that we passed up and say, how do we feel about that? Well, Nokia is good to add. And GSL is good to add. And was it Barclays? Oh no, BTG. Well, BTG, like I said, we have gold, but if you want to add one, the thing is that this fits into our 700 a month portfolio too. And then Barclays, I think, is a good play, but we already did that last week, didn't we? That was the first one we did. So that's what it's all about. It's just like at any given time, you say, okay, I'm ready to add some more stocks. So what should we add and how much should we add? And that's the exercise we did last week. And I think we did something else during the webinar. Didn't we add some stuff here? No, that's just an answer. How's Levi's doing? Didn't they just have earnings? Pretty sure Levi just announced. Oh yeah, look at that. Damn. See, that's another one I want to add. And again, not that we can't add it, it's just that we missed the dead bottom there. So 3 o'clock. What did I say? Just doing the webinar, dollar is not down, seems to be the same supply. According to news analysis, I found oil prices have risen to 72. Mm-hmm. Nope, that wasn't it. I don't know. I swear we were doing something where we added trades. You know, but then we just go back to the watch list. I'm not going to do that today because we've already done that. Oh, son of a bitch. Didn't mean to close that because I still want it over here. Finviz.com. And then I want to pick up this chart. Nope. Home. Okay. Apple. There you go. This doesn't seem as nice as my normal charts. No, I don't like it. Let's make that bigger. Okay. So what charts do I like? I like this chart. Open it, a new tab, and there. Oh no, too small. Ew. Gotta find a big one. There we go. Open in a new tab. That's the correct way. Okay, now we know what we're doing. Move that tab over here. And good. All right, so generally, you know, things are performing well. The income portfolio is up 20%. It's only 2 months, so, you know, 10% a month is pretty good. The $700 a month portfolio is still hanging out at 42%. So that's good too. This does not include the new trades, I don't think. No, it does not. Butterfly portfolio, 5.7%. Long-term portfolio has been lagging, 4%. Money to our portfolio that was not closed, so it's not a new one. It's from 2019. So that's what? That's 20, 21, 22, and we're halfway through 23. So 3.5 years, and we're up 300. Wow, 300%. That's a big jump. Okay. And then the short-term portfolio should be down 7%, which is not terrible. And we actually added a couple of bullish trades to offset. We also added a TZA spread to make it more bearish. So again, the best thing that could happen to us right now is for the market to correct, because we have such an, you know, we have a huge amount of hedges and really not that many long positions. So why is that? That's because when we started the portfolios in May, when we started the portfolios in May, where's May? Here's May. So we thought we were bottoming here. What was the NASDAQ at? That's more important. Wow. Why, you see, this is not a very clever index, right? If you put an NDX, it should really assume you mean the NASDAQ. Right. So in May, we were at 14,000, and we figured, you know, we're probably, yeah, right around here is where we came in. So about 13.5, I'd say, when we started building the portfolios together. And we figured it was due for a correction. Instead of a correction, we have gained 10% since then. But we think it is very, very overbought right now. As I said this morning, if you look at, not the PPO, I'm sorry. So let's see if we can pick that up this morning. Oh, where are we? Oh yeah. So okay, so you have the RSI, right? And the RSI very, very rarely is going to be over this 70 line. That's a very high mark for RSI. It doesn't tend to sustain that. And look at the penalty you pay right? See how fast, see what happens? You extend the RSI. If it's overextended for a long period of time, you get big corrections. Here again, a pretty, a big correction proportionally. This wasn't even big. This was a bigger one or more sustained, and you got a bigger correction. Now we have a not heavily over. This is the thing, though, we're not heavily over 70 to 70, but it's very sustained. The length of time is getting towards something like this, and this is what I am worried about, is something like this happening. And realistically, this is just the same. Do you see this? This is basically as if we correct to here. It's the same thing. Not a big deal in the grand scheme of things, but it's going to feel terrible when it happens. It's going to be 20%. That's 20% if it goes down that low. And also at the same time, the MACD is down, the MACD, and that also has a similar, so it's a similar concept. Wait, let me see if I can get the chart in view. So it's also going to tell you that it's oversold. With these bumps over here, will tell you it's a little bit overbought and then it wears itself back down. Then it's showing you under, right? Under a little too much. So it's basically, it's like steering, it's like saying a little more up, a little more up, no, a little down, a little more up, like that. And I was like, okay, up, this is way too low. Then it overcorrects, and that, why did it overcorrect? Banking thing, right? So it's overcorrecting, and it's almost like you can imagine them saying, oh, no, why, whoa, what's going on? This is too far. It's almost like it's saying that, because it doesn't, there's no reason, obviously it's just a chart with some numbers, but there's no reason that in the pattern, not in the pattern, in the flow, right? So it's like the flow of a river. It's not telling you anything. It doesn't give you any insights. It just marks what happened. But marking what happened, you have to say, what caused this? I built my house over here because I thought it was going to be safe. But what you didn't look at was what the 100-year flood line was, right? The 100-year flood line tells you that this does happen once in a while. Every 100 years, you get a great big storm that floods the riverbanks, and all of a sudden, the sea comes out this way. And it's funny, though, they don't have an inverse. And I think there should be some kind of a charting system that shows you the inverse of the 50-day and 200 moving average. So you would have a band. And I mean, technically, that's what a Bollinger Band is, but it doesn't work right. You should have just a simple inverse of this. So in other words, when this comes down, there'd be an inverse going up. And what that would show you is the top of the range, the top of the potential range, and how it's changing. It would be kind of a cooler chart to look at. I think it would make more sense. But anyway, so still imagine this is like a river, and it suddenly flows down and it comes to your doorstep, which you said which you thought would not happen. Or you wanted to build your house right on the river. You thought you'd be safe. You're like, oh, isn't this great? The stream goes right by my house. But then all of a sudden, the stream becomes a river that flows through your living room. We've all seen this happen somewhere, right? So now, here's the thing, though. It's been telling you too far. This whole time, too far. It's not correct. And meanwhile, you're getting into the extreme, right? It's like, this is a panic too far. It's like, no, not just a little too far. This is like teaching my daughters to drive too far. It's like, no. It's like you say left. Break. You get a little bit more excited as it keeps going, because it becomes more and more urgent that you do something about it. And again, a chart doesn't tell you anything but where it's been. It doesn't tell you where it's going. But understanding how charts work will tell us what's likely to happen. For the last, and this is weeks, these are weeks. So for the last 200 weeks, which is 4 years, right? So call that 4 years. So for the past 4 years, this has been the consensus of where the NASDAQ should be. For the last 50 weeks, and obviously that's 1 year. So for the last 50 weeks, the consensus has been here. So the consensus of the last 4 years and the consensus of the last 1 year has not really differentiated very much. What's differentiated has been the explosion of the last 6 months, only 6 months. So do we throw out 4 years of market valuation and even the last year in favor of 6 months? What has changed so much? Obviously, it's AI. Okay, AI has led to an explosion in valuations for major companies, especially for major companies like Amazon, Microsoft, Google again, the double counted Google, Apple, anybody, and frankly, it's like the .com thing, unfortunately. Anybody who says AI, is getting a bump. And I know in 1999, my real estate data company was called AccuSearch, and we weren't getting any attention from the investors. They could care less about a real estate data company. So we renamed ourselves AccuSearch.com, and suddenly investors were like, "What do you guys do?" I'm like, we do real estate data on the internet. And they're like, "Oh, that's brilliant." I'm like, that's what we were always doing. Before it was even called the internet, we had the data and we would send it to our customers via a local area, a wide area network, so WAN. So via wide area network, we would send the data back to our clients. That was the whole point of the business. We digitized the data and sent it to our clients so they could make title insurance adjustments and things like that. Because otherwise they used to have to go down to every single town hall and check the data themselves. We made it so they didn't have to by digitizing the town hall data and putting it online. It's very successful. But couldn't get anybody to look at it, even though really profitable, really great, good growth. We were moving into other states and couldn't get anybody to pay attention because we weren't pets.com or something like that. So just changing the name made the difference. So that's where you got to worry with AI, right? Because everybody's just saying, "Oh yeah, we have AI. Yes, we're using AI. Oh, we're going to use AI for this. We're going to use AI for that." It's kind of bullshit. In fact, where was I? Oh, it was Marriott. It wasn't Marriott though. It was somebody with Marriott. It was a company that deals with vacation points, and I have all these Marriott Vacation Club points, and I was looking like to do something with them. And so the company that popped up, they had a customer support window in the bottom. When you get on the web page in the bottom right, there's a customer support window, and it's definitely an AI. You can tell. And I said to it, because it's asking me questions like, "Okay, great. So, oh, we can help you with that. Boom. What's your name? What's your number? Get my information." And then it's like, then I had a question that couldn't be answered by the AI. And it said, "Oh, thank you so much for your inquiry. I'm going to have somebody contact you." And I said to it, "Well, what was the point of you then?" Why pretend to be your chat assistant if you're not capable of actually answering any questions? And it's really just there to intake your information. It's good because it does it. It made me do it where probably if I realized it was a computer, I wouldn't have filled it out. I did realize it was a computer, but I thought it was going to go somewhere. I thought it would actually tell me things. It didn't, though. It's a poorly trained AI that only is capable of very limited functionality, which is what 90% of these AIs are. I'm struggling with secrecy here. I know somebody who works at I know somebody who works for a major corporation. This is where the whole problem is. The reality of AI. I know somebody who works for a major corporation. They're on a project that's meant to be using AI to enhance the customer service experience, right? They are taking the company's data and teaching the AI how to basically do an intake for a customer. Great idea. But the problem is they're not spending billions of dollars to have an in-house AI that they control. They're using OpenAI, but because they're using OpenAI, the legal and frankly the IT department, I'm sure also, but the legal department for sure and the IT department are saying, no, 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 no. You can't put our company data on OpenAI. It's open. You're basically just giving away our company data and all of our systems and all of our intake things and our forms and so on and so forth. You're just giving it all away. This is all we spent decades protecting this information. So instead, they lease a private box from OpenAI. That's something that's how OpenAI makes money now. They lease a box for quite a lot of money. It's like $250,000, not a quarter million. Like it's like $250,000 a month license or something like that. But it only gives them access to ChatGPT version 3, not even like the 3.5 that we use. It's an older version of ChatGPT because the complexity of 3.5 is such that you can't host it on a regular service. It basically takes up a huge amount of Microsoft's cloud capacity. And Chat 4 takes up even more of Microsoft's cloud capacity. So you can't have that as a private system because they have to clone the entirety of Chat 3.5, of ChatGPT 3.5, taking up 10% of Microsoft's total cloud services to run 3.5, just so you could have your little private company information on it. Because there's no way to scale it down that way. That's not how it works. It has to be fed all the information of the world in order to tell you like where to go get dinner. You can't just program Yelp and say, here's Yelp's data, and now I'll tell you where to get dinner. It doesn't work that way. So in order for a company to have a private segment of OpenAI, they have to use the old 3.0. Now, here's the problem. The old 3.0, first of all, nowhere near as good as 3.5. It was not ready for market. They never rolled it out. They never intended to roll it out. It was a faulty version. Second problem, it is so slow, they can't get anything done. The project is pointless because they can't, it takes forever. Every time they ask questions, it's like minutes before they get a response. And they've got to do thousands and thousands and thousands of questions and answers and practice with it before it's ready to go. So just the time it's going to take them just to go back and forth and get the questions into it. And then when they do, the customers are going to experience the same thing. It's going to take forever to get answers. So that's the reality of AI. Such was the reality of the web back in 1999, because frankly, most websites sucked. They didn't give you good information. They were just basically a way to shove an ad in your face. That was the original web back in 1999. Is only they would have a page, a static page, would be built at great expense, frankly, and that would be your quote web page. But it wasn't actually useful. There were very few people who had useful web pages back then. It sounded great. Everything was .com this and .com that, but if you remember, the ordering systems were pretty rudimentary. You would go through sort of a catalog of pages. You would click on things and fill a basket, but it was really glitchy and slow and terrible. It only started getting better right around into the peak of 1998, 1999, and then it got way better starting after 2000, especially because the crash freed up a lot of technical programmers who were able to work with the web. So instead of wasting their time on pets.com and things like that, they went back to Amazon and said, thank God I've got a job, instead of starting my own company. And they worked their ass off to make sure Amazon made money and kept them employed. So we went back to like a normal business model. The problem was happening in 1999. And again, it goes the same thing with labor shortages, right, in this economy. In 1999, there's only X amount of trained high-level programmers who are familiar with web protocols and so on and so forth, right? So as we started, you had the big search companies and the big companies like Amazon and people like that who were well-funded. They started putting things online, but then FedEx wanted their stuff online, UPS wanted their stuff online. So there's more and more demand. Then all of a sudden, though, as the demand in the mid-90s got huge for programmers, all of a sudden, all these ridiculous little stupid companies would start offering stocks that in theory would be worth millions and millions of dollars, and they were stealing all the programming knowledge out of all the big companies, and that then slowed everything down to a halt. So the golden age of programming and web programming really went very poorly for quite a while because there was a massive shortage of people who could do the programming. Fortunately, kids were learning it pretty quickly in schools, and we filled that gap. Not only that, though, but the crash caused 90% of those companies to evaporate, and the programmers still existed. It's like a neutron bomb, right? The companies are gone, but the programmers are left alive to go work for big corporations. So anyway, it's not irrelevant because it's this is what you have to understand when you're investing. And not just in the individual companies that you're investing in, but you got to think about the reality of how efficient are we really going to get, how quickly. Are we really 20% more efficient now than we were in January? Just because ChatGPT exists? No, obviously not. Now, will we be 20% more efficient in 2 years? That's more likely, but that's what's happened. So what's happening now is the forward PEs, the forward potential earnings of these companies is now being placed into your current investing profile. So when I go to look at, let's take a look here. Well, let's take a look at our baby NVIDIA, who's the king of this stuff, right? Stockopedia. So NVIDIA, here's 2 years. So basically this year, from January, was at 150, and now they're at 430. That's a pretty nice gain, right? It's almost 200% up for the year. And they're in the right place at the right time. They happen to make the chips because they were making high-end gaming graphic chips. The functionality was the same as what they're using for AIs. So, and that's how it, people jury rig stuff together to get what they need. So the engineers who wanted to make AI chips found that the NVIDIA chips were ideal. And as the demand grew, NVIDIA started tailoring their chips more and more to these AI people who are using up a lot of their processors, their high-end processors. And so sales exploded. They went from they were 9 billion, then they went down, profits, profits 9 billion, 4 billion, obviously they're investing and wisely. Then the explosion of demand. So, into the last 2 years, these chips started becoming a thing. They invested more money in the chips. Now they're saying, okay, well, next year we're going to do this much, 42, and we're going to make 19. And we're into this year, we're into this fiscal year now, 2023 ended for them. So the question is going to be, did they really do this? Are they really ramping up for this? Are we going to see $5 billion in quarterly sales? Last year, they did $5 billion in sales. This year, they say they're going to do $5 billion a quarter. That's going to be really impressive. Really, really impressive. Not sales, profit. Next year, I can't even do the math, 7 billion a quarter, basically. So, they're going to ramp up like crazy and so on and so forth. Is it real? Are they really going to be able to make that many? Are we going to run out of silicone? Who knows what's going to actually happen? Is somebody else over the course of 2 years going to take it? But the problem is now, right now, they're getting a $1 trillion valuation. 1 trillion is 40 times that number, not this number, not that number. It's 250 times that number. It's 50 times that number. It's 40 times this number. So we're pulling the valuation from the potential of 2 years from now into what you're paying today. That is not necessarily fair. And that's what they mean when they say something is priced to perfection. You know, it's like when you read a business plan and it looks like, whoa, way to go. Oh, well, can't see it. If I move, it changes. It's like when you see a business plan. Let's see if I can get on it. There you go. So it's like if you see a business plan and it says, yeah, we're going to do this and this and this, and then a miracle occurs and you're going to be so happy you invested in this, right? You know, I'm not downing on NVIDIA. They're probably worth it. I'm just not going to chase them when I'm paying 40 something times the earnings they hope to have in 2 years. And this is where bubbles form. Everybody is paying now what they think is going to happen with AI in a couple of years. Just like in .com, you could always point to some successes, right? Like Yahoo, and then Yahoo collapsed anyway. But you can point to some successes and say, look at this. They took a model and they put it on the web. And you know, in Yahoo's case, it was finance. That was their big driver. It wasn't news. You didn't go to Yahoo News, right? You went to Yahoo Finance because we never had so much information on the web before. It's fantastic. It was like having a Bloomberg terminal, except you had it right on the web, all this data. They were like one of the first guys to really, really grasp that concept. And the discussion boards, and again, the discussion boards were very high end. It wasn't the troll fest it turned into. It was actually a lot of guys who were very knowledgeable about the stocks having conversations on the Yahoo comment board. It was a great place to go. And that was before there were a lot of blogs out also. You know, blogging started after 2000, not before. But that's the thing. Ultimately, Yahoo developed something that in the end brought them down because blogging became more of a thing. So the commenters went to places where they would be directly rewarded for what they were saying, or at least recognized for what they were saying, instead of just being like one of the anonymous 100 voices on Yahoo. That's what Seeking Alpha's problem is today. It doesn't really do anything for the authors. It's useless. But again, there's less and less outlets available, so they still have people trapped in there, but it doesn't attract a lot of new authors these days because they don't really offer much that can't be done elsewhere. So the danger is that you end up putting this stuff, especially when the market, the S&P 500, are the kind of companies that are directly benefiting from AI, but that doesn't mean that the average S&P stocks are worth it. Top S&P stocks by market cap. So who's the top of the S&P? By weight is not market cap, but whatever. Oh, top S&P by. I visited this page on 7.3. See, it's telling you. He said, "It's Phil." All right. So what? This January, isn't that weird? Apple's now $3 trillion. It gained $1 trillion this year. So good example, right? Apple is not really a heavy AI company. They're going to have to be. Siri's getting left in the dust, and it's important to them to have something like that. But they have the money and technology and all that, so I'm not worried about them falling behind. But anyway, so Apple, I would say I would almost say not really an AI company, but they're going to become an AI company by necessity. Microsoft AI, Google and Google are both AI companies. Amazon, obviously, cloud services. Berkshire Hathaway, not an AI company. UNH, not an AI company. Johnson Johnson, no. Exxon, no. Visa, no, not really. JP Morgan, yes, actually, financials are so data dependent. These kind of companies are the programming at JP Morgan and Goldman Sachs is as good as anything in the world. And they've got the machines, they got the systems and all that. So they're going to have the best private AIs. Tesla, if only you could put the AI in the freaking Tesla and make that drive the car. We're not there yet, so it's not really an AI company. Walmart, and again, they're users of AI. That doesn't mean they're an AI company. Walmart, no, although again, user of AI. NVIDIA, obviously the king of AI. PG, no. So most of the biggest companies in the S&P are not AI companies per se. When you look at the market cap, it ain't there, and the S&P is market cap weighted. But the big guys. So here we got. Well, these are extremely behind. I can't believe how old this stuff is. So let's just go by what we have and add 20%, let's say, or 30%. 2, 3, 4, 5, 6, 7, 8, and 8 and 8, 8 and 9 is whatever. Let's go up 10. Oh no, sorry, that was 8 trillion. That's what we were working on. So call this another trillion. And we'll add Visa. So 0.5. So it's $9.5 trillion. So let's be nice and call it 10 trillion. So each one of these is essentially a $1 trillion company. Now, how many of them are really AI? 1, 2, 3, 4, 5. So half. Then we go with the next 10. And we say 4 is 8, and 12, and 15, and 18, and 18 and 7 is 2.5, and 7 again is 3.2, 3.5. So now we're down to 3.5 trillion in the next 10. So we went from 8.5 to 3.5. And how many of these people are serious AI companies? Well, Meta is unfortunately a metaverse company, not an AI company, but they'll work on it. So let's call them 1. No. Yes. Yes. Gonna give me a yes. At best 4. Okay. So you get the idea. So first of all, in the top 10 companies, was it 10 or 20? Top 20, sorry. Top 20 companies, roughly half are real AI companies, okay? Below this, and I'll tell you right now without even doing it, nobody is. Because they can't afford it. Nobody's going to know. They're users of AI, but they're not going to be AI companies. They cannot afford it. So all AI is to these people is a cost of doing business. Just like the internet really was. And that's what people did not see in 1999. The internet's existence doesn't mean, hey, it's like, you know what it's like? It's like smart TVs. Have smart TVs saved you money? Or are you now paying? Well, it's really the whole concept of what happened with cable. Exactly what they said would happen is what happened. They broke up cable. Instead of regulating cable and maintaining and having government regulated fees, they broke up cable into a free-for-all. And now we have 25 different subscriptions that we have to pay for just to watch TV. It is staggering how much money it costs to watch TV now. I looked at it on my bill and I was like, holy crap. Got Netflix, Amazon, HBO Max, Disney Plus, Peacock, Paramount, these are all subscriptions. Oh, Hulu, Netflix. And you say, well, gee, Phil, that's a lot of subscriptions. Try canceling one and then hearing what my family does when you do that. And I'm wishing Netflix would crack down on this password thing, because I really want to tell my kids you're on your own. So it's just exhausting. You know, it's not a lot of money, but it's more than double what we used to pay for cable. I just found a new way to charge you. Anyway, same concept though. They are users of AI. They are not owners of AI. So let's take a look now. Pfizer, AbbVie, Merck, Coca-Cola, Bank of America, Pepsi, Broadcom. Broadcom is not a user of AI. Oracle, not a owner of AI. They're a user of AI. Thermo Fisher, Costco, Cisco benefits from it because of more traffic, but not an owner. McDonald's, making great use of AI, but still they rent it. Abbott, Donna, Nike, T-Mobile, not helping them. Accenture, Nextra, Verizon, Walt Disney. You know, Disney now, and again, even in Pixar though, even if they are doing it, in fact, people are screaming because Disney is using AI to make the opening of the new what is it, Nick Fury, the guy with the eye patch. So he's got a TV show now on Disney Plus. I know that because we have Disney Plus. And so I got to tell you, Disney Plus gets me. They don't have many shows, but they get my vote because holy crap, they have some really good superhero shows, and they have all the superhero movies. So frankly, I just don't go to the movies anymore, and I watch it on TV. So that works out. That one's worth it. So where was I? Disney, yes. So for the Nick Fury show, they have the entire opening sequence illustrated by an AI. And people were freaking out when it first came out, but now it's calmed down. And as it calms down, you're going to see a lot of companies doing that. But they're being users. They don't own the AI. They're working with Midjourney or whatever and getting it done. Wells Fargo, Lindy, Philip Morris, Adobe, and again, Adobe making great use of AI, getting huge because of AI, benefiting from it. How are they doing? Let's see. Oh, we gotta go look at that beige book. Wow, look at that. They deserve it though. I mean, they make great use of AI. I wish I could find it. My daughter on a bring your daughter to work day. I mean, when she was like 12, Adobe was the stock that she picked. I made her do my job. I made her like, figure out a stock that I said to her, I said, look, you think of stocks you know about, companies you know about that you think are doing good and have good ideas and will grow. I said, let's start with that. So she looks at some companies, we talked about pros and cons. But her premise for Adobe was actually brilliant because at the time, Adobe stock was way down because they used to sell Adobe packages and they were like $500 or something like that to buy the software. And people didn't have that. And even the educational discount was $250. And their sales were slumping and it wasn't going good. But their solution was to, this is when Jackie had to be 12 or something like that, maybe even younger than 12. So it'd be about 2010, not 2010, 20, she was 102, so 2012, 2014 in that range. And so she wrote this article, and I helped her write it, of course, but her premise was, she explained it to me, she's like, we use these, they have these magic boards in the school, and I still to this day don't even know what a magic board really does, but there's some kind of effectively a big computer screen thing in the school that the teachers use. And she goes, they all use Adobe. And the kids all want to do this at home and be able to use it, but they can't afford it, blah, blah, blah. And so Adobe was changing their ownership model to a rental, to a subscription model. And it was going to be $19 a month and $10 a month for school kids. And she said, Dad, every single person who can afford this is going to get it. She goes, every one of my class is getting this. They're like, everybody, it has to happen. She goes, and she's like, you have to get it for me too. So it was like, so you end up spending $100 a year for your kid to have Adobe when they're in school. But you think about the cascading sales of that. She was right. It made it more accessible to more people, which increased the demand, which actually ended up driving the high-end package sales. So the whole thing worked out brilliantly. Adobe did great. They turned into a monster company, all because of changing their model to a subscription, which made more sense. Meanwhile, still doing good. So they're a good company. They've got good management. They think ahead. They grasp onto new stuff. The subscription model thing was very, very untested at the time, and people, you know, basically people thought that was the company giving up when they went to a subscription model. Schwab, Comcast, again, user but not, you know, they benefit from AI just the way you benefit from having Microsoft Windows. It doesn't, you know, you can't say you're a software company just because you bought Windows, right? You're just using it. That's all. That's what AI is. It's something you're using and paying for. So for a lot of these companies, it's going to be an expense where they have to keep up. It's not going to necessarily, you know, change everything for all these smaller companies. And when I say all these smaller companies, we only found 9 actually. We're only 9 actual companies that are directly selling the AI, that own the AI and are selling it to others. Everybody else is a buyer. So the excitement about AI and the future of AI, you can't just extrapolate it out to every single company you've ever heard of. It doesn't work that way. So Jeff says, I think you added BXMT and Barclays and T and WBA to the income portfolio that were not on the power option screen. Added 628. Well, 628 is after the last thing, so I haven't done the update yet, and before this update, where so basically this weekend, that's when I have to go back and make sure I add everything to the portfolios. So, you know, you're basically seeing however it was on 628 is how it is now. So you're seeing how those stocks perform, not necessarily the new additions, because you have no idea how hard this is. Taking me like an entire weekend just to update the portfolios. So I don't do it that often. Anyway, Fed, Beige Book. Before we run out of time, busy day. The Fed Beige Book. Stop that. Whoa, way to go. Oh, I see. You got to click on it. Oh, Beige Book. Very tempted to have it highlighted for me. I think my voice is okay though. All right. I looked at keywords. Overall economic activity increased slightly since late May. Like, whoops. Slightly. 5 district reported slight, modest. 5 slight, modest. 5 no change. 2 with declines. Okay, that's not good. That's flat. So we're flat. You got to average that out and say flat. Reports on consumer spending were mixed. Growth was generally observed, but some noted shifts away from discretionary spending. People are, and again, my theme, you know, I do these webinars, I assume you guys are reading my stuff also during the week. So my theme, which we've been discussing for a couple of weeks, is the discretionary spending. Because wages are not going up to keep up with inflation, discretionary spending is petering out, and people don't have money to spend on anything other than the basics, the necessities. Tourism and travel activity was robust, and that's because people haven't taken a vacation in years, so there's a backup there. Hospitality contracts expected busy summer season. Auto sales remained unchanged. or exhibited moderate growth among most districts. Manufacturing activity edged up in half the districts and declined in the other half. That's weird, but okay. So flat. Transportation activity was down or flat. Down or flat is the theme here. Reduced demand due to high inventory levels. Of what? Of transportation, and another continuing from labor shortages. Again, labor shortages, big theme, right? Labor shortages, labor costs, lack of discretionary income, except for vacations, apparently. But I get that. I get that. You're like, your family's like, I'll be damned if I don't take a vacation. I mean, my parents were bankrupt in 1972. We drove to Florida, all of us let's see, there were 6 kids and a dog, and my parents in a station wagon. We drove to Florida because my dad's friend had a house in Margate he wasn't using. I don't even know where Margate is to this day, and I live in Florida now. But I do know it had a lot of mosquitoes. I'll tell you that. Had a 7-Eleven, sold Slurpees. I was 72. I was what, 9. Had a 7-Eleven that sold Slurpees, and it had mosquitoes. That's what I remember about that trip, and being in the car. That's what I also remember about the trip. Spending like a day in a car, or 2 days in a car, or whatever the hell it was. It was 2 days, right? We traveled, we stayed at a hotel, and then we traveled again. And that's literally all I remember about that trip. Not one other thing do I remember. There was I remember playing in the river that had it wasn't a river, it was like a stream that doesn't go anywhere kind of thing. That's where all the mosquitoes came from, I'm sure. I remember having horrifying mosquito bites, and I remember and I remember my primary joy of that trip was going to 7-Eleven and getting Slurpees on a daily basis. That was basically the highlight of the journey. But again, no money, still take a freaking vacation, right? It's just, you have to do that. Manufacturing activity edged up in half the districts, declining the other half. We talked about that. Transportation, banking conditions are mostly subdued. Lending activity continued to soften. These are not good. Despite higher mortgage rate demand for residential, real estate demand remains steady. Although they're steady at an incredibly, see again, you got to read into this. It's steady, but we know the number is incredibly low. And sales constrained by low inventory. Construction for both residential and commercial units. Hang on a second. Why is this even big? Okay, whatever. I don't know why this is binging. It's supposed to be silent. Oh, it's not. Haha. There you go. Now I know. I thought it was some emergency because it was binging through silent. Banking conditions were subdued. Lending activity continued to soften. Higher mortgage rates, demand steady. Sales are constrained by low inventories. Construction was slightly lower on balance. Agricultural conditions are mixed geographically, but softened slightly. Wow. Is there anything that wasn't softened? Some context further softening. No. Energy activity decreased. Wow. Overall economic expectations generally continue to call for slow growth. Labor markets. Employment, we finally went down to 200,000 new jobs from 400,000 or 500,000. With most districts experiencing some job growth, labor market demand remained healthy, though some contracts reported that hiring was getting more targeted and selective. Employers continued to have difficulty finding workers, particularly in healthcare, transportation, hospitality, high-skilled positions in general. However, many districts reported labor availability had improved. Some employees were having an easier time hiring than they were previously. Employers also reported that unusually high turnover rates appear to be returning to pre-pandemic norms. So less people are quitting their jobs and taking other jobs. Wages continue to rise, but more moderately. Context in districts are wage increases returning to nearing pandemic levels. Prices increased at modest pace. Several districts noted some slowing in the pace of increasing prices. We just found that out today. Consumer prices generally increased, so reports differed from firms. Which firms were able to pass on their input costs. Reluctance to raise prices because consumers have grown more sensitive to the prices. Again, running out of money, that's a problem. While others reported solid demand and allowed firms to maintain margins, input cost pressures remained elevated for service firms, but eased notably in manufacturing. Freight rates continued to decrease along with the prices for many construction inputs. Concrete increased. Price expectations were generally stable and lower over the next several months. And that's it. They used to have such a better report. It's sad. Then it breaks it up into each of the districts one by one, which it used to be all about the national and they would have notes from local. Now it's all about the local and they have notes for national. But this is not good. This is a really recessionary sort of report. So you got to be careful with this stuff. The overall conditions are not great. San Francisco, see, that's it. It just ends. So it's all about the locals. So what matters here is this summary. At least you get to go through it quickly, but it's depressing. It's not a particularly good summary. Doesn't bode well for what's happening in the economy. So what else is going on? Check out the news. Citi gets positive on Liberty Sirius XM with Atlanta Braves split off pending. Sealed Air, I like Sirius XM, they got bought up. Sealed Air raised a bar. I like Sealed Air. Take two. Oh, I remember. There's one of Warren Buffett's favorite indicators of how the economy is doing is the use of cardboard boxes. And there's been a slowing trend of cardboard boxes, and people are starting to point to that and saying, oh, the economy's in trouble. But you got to remember that this is an indicator that he used to watch in the 80s and in the 80s and 90s, whatever. But the point is, it's a 40-year-old indicator. If you think about cardboard boxes now, what happens when you buy from Amazon, which is now 10% of all sales are Amazon, right? And you don't do a lot of mail order if it's not Amazon. And Amazon tends to bundle your stuff. They put several things into a box. They're trying to save on boxes themselves. You get less things by UPS that are not from Amazon. So you're not calling hundreds of different companies who are stockpiling boxes in their warehouses and so on and so forth. Basically, everybody just ships to Amazon, who acts as a distributor for all the companies that used to do mail order products, right? Because you don't get a lot of mail order stuff these days. So I think that the indicator isn't necessarily functioning the way it should, because what you're seeing is sort of a decline in that sort of transaction that would require these boxes. And obviously business to business, there's a lot of boxes going back and forth and other stuff, but I think that the overall, I think it's in decline. I think you see that from Weyerhaeuser and International Paper also. You see that individually, I think cardboard production is not as big as it should be. It would be nice if it was bigger because it would be less plastic also. There was too much plastic packaging these days also that we didn't have 40 years ago. Everything wasn't wrapped up in plastic and used a lot more boxes for everything. So I think you got to be careful when you read these things and you look at this stuff and you got to think about like the history of it. It's a lot, you can't just take the surface of everything. Chips rise after NVIDIA 50 million AI investment, Broadcom deal approved. Oh, Microsoft Broadcom's approved too. That's a market booster. It should be. How are we doing today? Oh, look, we're coming back up. Wow. Oh, oil's back to 75, 78. Holding on to that short. I still believe in it. Merck intensifies fight. This is what's wrong with capitalism, right? You have this great big giant company that's fighting against humanity to stop the government from negotiating drug prices. Like, okay, well, we're a government, we're buying drugs for 100 million people, we'd like a discount, please. And Medicare is like, you can't do that, that's illegal. It's insane. Oh, beige book. Now, what is this? What are they reading? Wow. Bloomberg. No, not Bloomberg. Seeking Alpha. Who is this? Max Gottich, an editor of Seeking Alpha. Economic activity in the U.S. rose since May. The Federal Reserve said Wednesday the beige upgrade from little and up. Wait. What is he talking about? 5 reported slight or modest increases. 5 reasons had no change. 2 described modest. So he's keeping a score as if it's like you have 2 declines, 5 modest increases. The same word. 5 modest up, 5 modest down, 5 flat. So it's 8 flat or down and 5 up. And he says that's he's calling that. Wait, what's the headline? He's calling that economic activity is higher. I don't know where the math is on this. Yeah, okay, I guess it is slightly higher. I guess you could stretch and call it that. Okay, well, that's interesting. So he actually looked at the districts. I don't see how he could have in 2 minutes. This came out 2 minutes after the thing. 3 minutes after. He had 3 minutes to find all this out. Probably AI. 5 districts reported slightly modest increase. 5. Okay, so the 2 described the districts. Okay, here's the thing: Boston, Richmond, Atlanta, Minneapolis are not major districts, are they? Philadelphia and San Francisco are much bigger than Richmond, Boston, Atlanta, and Minneapolis. Okay, and obviously New York and whatever are the flat ones. So you have to weight it, not just look at the surface. Again, it's just lazy bullshit analysis. Manufacturing activity advanced in half the districts, dipped in the other half as supply chain, blah, blah, blah. Transportation was down to flat. Even with the mortgage rates on the rise, demand for residential real estate held steady, although constrained. During the period, employment is very cherry-picked, isn't it? During the period, employment rose modestly. Most districts reported growth. Employees continued to have difficulty finding workers. Many districts reported labor availability. It's the same thing we looked at. Prices increased modestly. Several districts. How do you take that and come up with this headline? It's insane. Wow. General Motors trades higher. Yeah, we bought Ford. We didn't buy GM, but we like it. Sony rises. Goldman Sachs adds conviction buy list. Wow. Coinbase adds instant messaging feature to crypto wallet. I don't see how that's a big deal. Coinbase has gone very well lately. Another table banger for me. Look at that. It's okay if they're down. It's okay if they're down 3% when they're up at 85.94 now. Holy cow. How many times have I mentioned Coinbase in the last year? They're in the long-term portfolio, but they're too risky for the other portfolios, but they're in the long-term portfolio. And by risky, I mean literally, it's an $85 stock. So I sell 5 puts, that puts me on the hook for 40,000 bucks. That's a lot of money. So I don't take that lightly. I can't, and if I can't set up a play properly, and you say, okay, we'll take the play without the puts. We did, in fact, we bought them back. We bought back the puts because we had made money on the puts. We bought them back because we thought it was too risky going into the decision with the SEC, but they kind of seem to be escaping it and they shot up. But it doesn't matter. We didn't lose money. We were ahead on the puts. So I said, well, let's just buy them back and not take the risk. And so we did end up with just the bull call spread. But again, we couldn't afford that kind of play because we spent 17,000 buying back the puts, or 13,000. We couldn't afford that play. in the smaller portfolios. You can't just move that kind of money around in a $100,000 portfolio. So the long-term portfolio, we have the cash to make the right decision. It was around here, we decided we didn't want to take a risk on it possibly dropping below 50 and getting assigned. So we took the puts off the table. The puts were profitable, not much, $1,000, $2,000. But the point was we closed them, we have a profit, we still have the bull call spread. So we basically took $2,000 off the cost of the bull call spread, but that's going to make very nice money now. What else? Okay. Cummins, who cares? Elements, BASF, full year earnings, sales guidance. Sharp declines, BASF, interesting. Chipotle looks for a breakthrough in guacamole prep time. I got to tell you, I think their guacamole is terrible. I know most parts of the country don't have any good Mexican food, but you know, if you have real guacamole made with chunks of avocado and stuff, the paste that these guys make, I mean, it's just buy a great big blender basically, and that's your guacamole. Just throw avocados in a great big blender. They do not make good guacamole, in my opinion. So I'm not sure kind of, well, it just amazes me that there is prep time for that, because it's just so awful. I have a place right next door to me, makes table-side guacamole. You know, they do the whole thing. They take it out of the avocado shell. They put in ingredients. If you want more or less of something, you tell them while they're doing it, and they mash it all up in a bowl manually. It's great. That's what guacamole prep should look like. They should have a guy walking around Chipotle just doing that. So anyway, nothing too exciting. Jeff Bezos, one of his rockets blew up today. Elon Musk is XAI to understand real. Oh, for God's sakes, come on. He wants to understand. That's so funny. Pepsi's coming up. We got a lot of earnings coming up. I mean, that's going to be exciting for the next couple of weeks. Total Energy is 12. See, this is the thing. This is why I like TTE. How are they now? We had them in the old portfolios. We didn't buy them back. They're expensive, actually. Well, they're not expensive on a PE basis. They were just expensive for the portfolios. This is not bad, though. Let me see if that makes sense. $140 billion, not a small company. $25 billion. Even $20 billion. You're talking about 6 times earnings. Net debt, $25 billion, not too bad considering the size. $35 billion cash. Yeah. See, I love Total Energies because they went heavily into alternate energy. They diversified themselves as one of the first big oil companies to diversify themselves, and look at how it's paying off for them. $12 billion contracts. You have to keep it. And again, when you read an article like this, right, and you see BP and Total win in $12 billion German offshore wind farm. So let's say they got 6 total, whatever it is, it's not important right now. How much does that impact their earnings? Well, it doesn't really, does it? It doesn't actually impact it at all. But it's good to know they're doing stuff like that. And I'm sure that if you look at it, alternative energy is probably 20–25% of their portfolio right now, but it's getting there and they're pushing on it every day. So I see stories like that. And I'm like, yeah, great. You know, it's like they're executing this plan. But see, it sounds exciting when you see 12.6 billion, but then you realize that they've got half of that maybe is 6, and their total revenues at $250 billion. So very drop in the bucket. But the point is that's the direction they're heading, and it's more and more of that and less of the oil field. Although the Total CEO himself has said, we're not getting out of oil. He says we're not reinvesting in oil, we're reinvesting. So our new sources of energy are all coming from alternative energy. Our old sources of energy are not being shut down, we are just playing them out. So the wells we've already dug and the stuff we already have, we're selling it, we're depleting it, and when it's done, it's done. and will be all alternate energy. But right now, whenever we start new projects, all alternate energy. So they've really, they're executing on their plan to do that. Another dollar store is hurting. It's a trend lately. THC infused sparkling drinks. That's fun. See, it's dangerous when you do that though, because then it's like people at parties. It's like, you get thirsty and you drink more drinks and you're taking too much. Microsoft Broadcom. This is weird. A deal that's been in progress for over a year with massive delays due to regulation, and you're going to make a statement that says Microsoft Broadcom shows M&A is back. How is it back? It's a deal that was started more than a year ago, and it's been held up and delayed and kicked around every single country where everyone has their say in what it's going. And finally, probably, not even definitely, probably now it's going to be able to go through. And you're going to say this shows that M&A is back? It's got nothing to do with M&A at all. Nothing. That's a ridiculous statement. The person who wrote that should be shot. Jeffrey should be shot. Airline stocks trade lower after airfares drop. That's weird to me. I mean, he record summer travel, airfares dropping. Kind of weird combination. State Street doing whatever. Domino's, this is big for Domino's, and they're up 11%. Yeah. Domino's and Uber have joined forces. SunPower, Raymond James. Oh, that's SunPower. Raymond James raises to strong buy after excessive weakness. We knew that. Activision drops after UK may report of a new micro. Oh, wait a minute. Activision drops amid report UK may need to do a new probe. And the article after that says they're doing great. What is the truth? ATVI. Nope. Looks like the bulls have it on that one. That's weird. Wait, how far apart are these? Oh, that wasn't Broadcom. I'm sorry. That was a different deal. It's Activision, Microsoft. What are they talking about? Oh, I see. They're talking about the Microsoft Activision. And that's the one I meant that was held up and whatever. But meanwhile, it's like, yeah. That's a good trade when Microsoft's up and Activision is up at the same time. That means it's a synergistic deal. And that's pretty much it. Nothing too exciting otherwise. Anyway, so that's where we are at the moment. It looks like, what does it look like? Well, we got earnings, so let's not say anything looks like anything. We have the bank earnings start up on Friday, and next week we'll have a decent amount of earnings reports. We'll start to see what people are saying. Everybody is already they've got a very low bar. Already everybody's saying that the earnings are going to be worse than last quarter. They're going to be worse than they were last year in comps. So nobody has high expectations. But again, how do you support this forward reality, this forward sort of expectations of getting 40, that you're willing to pay 40 times earnings now because you think that AI is going to make everybody incredible, like everything is awesome. Which is frankly, everything is awesome is what we used to make fun of back in 2007 or whenever the hell it was, when the Lego movie came out. It was the same crap. It was like the market just went up and up and up regardless, and everything was awesome. And it was, you're just ignoring everything that's going wrong just because you have this vision of something great that's going to happen. And that rally was being driven by mostly the housing market, where houses were going up and up and up, and people were refinancing and flipping homes. Remember flipping homes? Nobody flips homes anymore. People were flipping homes. They would buy a home today and sell it 2 days from now for a profit. And then the next guy would come in and he'd buy the home and sell the home 2 days later for another profit and another profit, because there was no end in sight, because that's how everybody makes money. And it's just like any mania. Those bubbles pop. because it's not based on anything real. It's just based on speculators speculating. It's based on extrapolators extrapolating. And so all I'm saying is that we're not realizing the gains that everybody is paying for now. And it's a long, long way to say a company is going to become 20% more profitable, 30% more profitable in 18 months or 2 years just because they started using an AI. And I think AI is great. I think AI is going to lead to another productivity revolution, but not this year, not next year. And again, the cost is going to be interesting because there's only so much to be made. It's almost like replicating the internet. It's like saying, I'm going to have my own internet. No, you're not. And that's what happened, frankly, in the early days of the internet. Companies wanted to make their own internet. And there were rival things, rival networks being set up, but you can't have a rival internet. It's too big to make more than one. It doesn't make sense. And that's where you are with AI, because it's too big. It takes up too much of the total capacity of service and too much of the total capacity of traffic. And you can't just have this AI and that AI and that AI. And just like the dot-coms, there's only going to be a couple of survivors. And it's only going to be the nine out of the Fortune 500 companies, 9 companies are the only ones that are really capable of having their own AIs. And it's going to be just like signing up for broadcast networks. So it's going to just cost us all more money. If ChatGPT and Bing have different capabilities, and Google has different capabilities, and Amazon eventually has different capabilities, and they don't share and they don't communicate in an effective manner, then we're just going to pay $20 to that guy, $20 to that guy, $20 to that guy, so we have access to stuff. Because it's all going to go subscription. It's only right now it's free because they want everybody to get hooked on it. And then once it's just like any drug, right? It's free right now, but once you need it, it's going to be, they're going to charge. And that's what they were already doing to companies. So I think it'll be more useful to companies when they're able to share private versions of Chat 3.5, which is what we have now as a free use for users. I think at that point, you're going to get to the point where it's useful. As it stands now, though, the way ChatGPT is, and I'm sure everybody's in the same boat, they can only use their old small version. That's not going to cut it. It's not going to give anybody enough improvement to make it worth doing. So basically, I just think we're ahead of ourselves. The expectations are ahead of ourselves. And you're certainly not going to see it in this quarter's earnings, but we'll see what the guidance is. But even the guidance, though, it's the same thing. Because, the CEO of UPS is a truck guy, probably. I mean, not, sometimes they're an airline guy who came over to UPS, whatever. But, generally, that, again, the 491 non-AI companies in the S&P 500, of them, I would guess at least 300 of them don't have a clue about AI or what it does. They have as much of a clue of that as they do about SQL. Okay, all they know is that we have the system that does this with the data and it does that with the data, and we get these kind of reports. That's all they care about because it's not their job. It's not what they learned. But for the companies to really benefit, it can't be just a black box to them, and it can't be something they don't understand. And then the same thing's going to happen, though, because 300 of those 500 people, probably more, are going to sit there and give you forecasts that say AI is going to be amazing and we're going to do this and we're going to do that, because that's the bullshit they heard. They haven't implemented it yet. They don't know what it's really going to do. I'm telling you, I wish I could talk about it. I know somebody's in a project And that project is with a multi-billion-dollar company, one of the largest companies in the world. And one of the ones, in fact, that we went past in the top 20 that I shouldn't keep giving clues, but that's implementing AI, and it's a disaster because it has to be a disaster because you're using an old system. They never should have started the project. They didn't even understand what they were buying. They weren't buying it, they're renting it, so I guess we'll just stop doing it. But they're trying it. It's a disaster. It can't be done. That's the end. The end of it is can't be done with this. You could look at it and say we're learning, and then when the next version is available, we'll be able to use it. But will 3.5 ever be available? Will there ever be that much capacity on the web for many multiple versions of ChatGPT to be out and taking up server space? Is it going to be cost effective for Microsoft to double, triple, quadruple their cloud platforms, and Amazon double, triple, quadruple their cloud platforms? That's a lot of money. That's a huge expense. It's going to take many years to build it up. How many chips are available? How much power is available? How bad is it for the environment? We're not looking at these things at all. We're just, we're pretending it's this magic box. It's come to our lives. It's not. It's a tool. It has to be used properly, and it has to be implemented properly. And we're nowhere near even having those discussions. So let's see. We will see what happens in the next couple of weeks. We'll talk about that. We'll look at a lot of what people are saying forward. But like I said, a lot of people are going to say forward. They expect to save this and do that and do that. It's not realistic. You know when it's realistic? When Microsoft has the terminals talking to you, and the food is made automatically by by more machines. Right now, McDonald's has cut out all the order takers. They put big giant screens in the place when you walk in. It's a kiosk. You walk up to it, you give it your credit card, you go bip bip bip, and you punch on the screen and do it. Why? It's not AI though. What is that? All that is they made their ordering system so easy that they could train a 15-year-old or a 16 or whatever the working age is. They could train a 16-year-old kid who's never had a job in their life to walk into McDonald's, and they can teach him in like a half hour how to take orders on the cash registers. Because it's all pictures. It's it's exactly like a picture. You want fries, picture of fries. You want Coke, picture of Coke. The machine says, would you like small or large? It tries to upsell you the next item. It's right there. All they did is take that and say, this is so easy. We think that basically 90% of our customers will be able to use it with no instructions. They were right. So people walk in and they like it better because it's better than talking to the incompetent 16-year-old who's trying to figure out the buttons that you can tell exactly what they mean right there. So my kids are like bip 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 bip, and they're done. It's like 2 seconds for them to order for everybody on the thing. It's faster than the drive-in. It's better. It's more effective. Nobody makes a mistake. You get exactly what you're supposed to get. So they have that, and then there's like now they've sealed off everything except for the kitchen window. Come through the kitchen window. They hand you the food. Goodbye. That's it. That's their entire interaction with you. It's like basically it's like ordering online, except you're just standing right there in the store. So that's not even AI. But when you see McDonald's and companies that are super forward in their computers start using it, that's when it makes sense. When you are talking to AI assistants on your screen and you're like, damn, I can't even tell the difference. That's when it's being used properly. We're nowhere near that. And that means the companies are nowhere near realizing these efficiencies, and that means that these valuations are bullshit. All right, so we'll see how that plays out over the next few weeks. Thanks for coming, everybody. I hope that was informative, and we're hopefully now prepared to go into earnings season. All right, take care. See you next week.